Thanks for clicking. Persistently high inflation numbers has investors betting that the Bank of Canada will have to reverse course and raise rates, less than a month after announcing it would be pausing.
Why do you do this to me?
Indeed, with U.S. inflation numbers coming in hotter than expected for the month of January, Canada's bond yields have risen to their highest point since the beginning of 2023, before the Bank of Canada announced that it would be pausing on rate hikes, with investors betting that interest rate increases are coming to a theater near us. Yet we're also seeing mounting evidence that the rate hikes are working, with a growing number of Canadians saying that they will be pulling back the spending so long as interest rates remain high. However, as a result, we're also seeing a growing number of stresses throughout the system, with insolvencies up and the number of delinquencies on auto loans growing as well. So what I want to do today is go over some of the recent reports that have investors betting that the Bank of Canada will be reversing course on its pause, discuss some of the growing evidence that the rate hikes we've already seen might be working, and then go over what to look for next. Speaking of next, Canada's inflation rate for the month of January is set to be released on Tuesday, which could have a big impact as to whether or not the Bank of Canada does decide to raise rates. Experts are predicting that the inflation rate will be coming in at 5.6%, but as we've seen so many times on this channel, experts are often wrong.
Name one time!
We'll obviously have an update out on January's inflation data on this channel. Click like and subscribe if you want to get that update, but for now, let's get into these reports. As mentioned, U.S. inflation data just came in yesterday hotter than expected, with the CPI rising at its highest rate in the last 3 months. The news is the third indication in as many weeks that the CPI may be more stickier than many had hoped, with U.S. job numbers coming in much hotter than expected 3 weeks ago, followed by Canada's own blowout job numbers coming in 10 times more than expected on Friday, with over 120,000 of those jobs being full-time. Between the three reports, the yields on 5-year Government of Canada bonds have gone up over 50 basis points since the Bank of Canada announced this pause at the end of January, with traders betting that the bank will indeed have to go higher on rates.
In so many words, yes.
Indeed, for their part, the markets have gone from pricing in 2 rate cuts by the end of the year to pricing in 1 rate hike, this time in July. So we have much higher job numbers in the US, 10 times more jobs created in Canada than that which was expected, and we have inflation coming in hotter than expected in the States as well, all leading investors to think the Bank of Canada will have to reverse course on its pause. Yet despite these reports that are sure to have the Bank of Canada rethinking its pause, we are starting to see some signs that these rate hikes are working, with the pain that the Bank of Canada very much wants to see starting to come to fruition. A new poll from Nanos just released found that 60% of Canadians say that the rate hikes will affect them negatively over the next year. In fact, the survey found that the number of Canadians who are more worried about the impact of interest rates than they are about the rising cost of goods has increased over the past 6 months. Increased marginally, but still going in the right direction. Further, delinquencies on car loans, late payments, and non-payments of car loans have now surpassed pre-pandemic levels, as the higher cost of borrowing and inflation eats into the wallets of Canadians. And the higher cost of interest and the higher cost of goods is translating into more insolvencies on behalf of Canadians, with a recently released report showing that insolvencies were up an average of 19% in the second half of 2022 and up 23% in Ontario. And it's not just consumers that are feeling the pinch of the increased cost of borrowing, with insolvencies up 48% in Ontario and up 37% Canada-wide in the second half of 2022. And while the Bank of Canada definitely does not want to see the blockbuster job numbers that we talked about earlier, it does want to see some pain coming to consumers, coming to businesses, coming to Canadians in general, as rate hikes, almost by definition, are meant to cause Canadians to spend less money.
Make up your mind!
So, in summary, we have U.S. job numbers coming in strong, Canadian job numbers coming in strong, and the U.S. inflation rate coming in hotter than expected, all within the past 3 weeks, all after the Bank of Canada announced that it would be pausing on interest rate hikes. With that said, the job numbers that we're seeing, combined with the stresses, with the cracks that we're seeing in the system, must be making the Bank of Canada a little nervous, as the negative effects of the rate hikes, including insolvencies, are starting to set in. But we're still not seeing any change in the job numbers. If anything, the job numbers are getting better. The clock is ticking for the inflation rate to show signs of a sustained slowdown. We're seeing these cracks in the system start to emerge. We're seeing increases in insolvencies, in bankruptcies, in delinquencies, but we're not seeing a slowdown in the job market. We're not seeing a sustained, long slowdown in the increase in the price of goods. But it's not immediately clear that the Bank of Canada is going to be able to maintain its pause. Rent prices are still surging. The US is continuing to subsidize world oil prices, which can't continue forever. And as mentioned, the job market remains red hot and inflation numbers continue to disappoint. While investors are betting that the Bank of Canada will have to raise rates eventually and are going to raise rates eventually, I don't think we're going to see it at its March announcement, as the bank probably wants to see what happens with the job numbers with the inflation rate for at least the next 2 reads. With that said, we'll obviously have an update out on Canada's inflation rate when it's released next Tuesday on this channel. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.